It's another crazy day with the stock market across the board in the green. And this comes at the same time where Russia is literally at war with Ukraine. Russia forces close in on Kiev, the bombing intensifies, and the latest news is that Moscow agrees to talk in Belarus with the Ukrainian leadership. So this whole situation is evolving right now, but so far things have escalated far past what most people expected. Now, of course, in response to this, the United States and the West are issuing sanctions on Russia. There's been a lot of discussion about this SWIFT system, kicking Russia off of SWIFT. And we're going to discuss a little bit about what that means and what it could do to the global economy. Now, this news is incredibly tragic, and my heart goes out to everyone in Ukraine that has to deal with this. But this is a very volatile, constantly developing situation that ultimately nobody really knows how it's going to turn out. And in spite of all of this, we had a huge green surge in the market yesterday. We have another big green day today, which may be perplexing to some, but it seems as though investors are becoming more accustomed to investing during times of high uncertainty. After all, the 2020s hasn't been an easy time to invest. We've invested through a global pandemic, a virus that's killed millions of people. We're also investing through incredibly high inflation, the highest it's been in 40 years. And now to add to that mix, in just a couple short years, we have a war going on in Eastern Europe. So overall, there's just no other way to put it. This has been an incredibly stressful and crazy past couple of years for the entire world, and events seem to keep escalating out of control. Now, we're going to go over all of that in today's episode. We'll be discussing Russia and Ukraine and the current news going on, as well as we'll be looking over my portfolio and seeing if any of this type of news changes the direction that I'm going or changes any of my investments. So we'll be going over all of it. So as always, we have a lot to jump into in this episode, and let's go ahead and dive right in. First of all, if you're new to the channel and you want to see portfolio updates with complete transparency every single week throughout the year, you can subscribe to the channel and follow along for free. I'll be showing all the investments I'm making, as well as how they turn out with complete transparency. Now, of course, the big news of the week is that Russia has invaded Ukraine, their forces are closing in on Kiev, and the latest news just recently is that Moscow is agreeing to talk in Belarus with the Ukrainian leadership. How that will turn out, or if it will be fruitful, is completely unknown at this point. Now, of course, as a reaction to this invasion, the US has imposed sanctions on Russia. But the sanctions don't seem to be deterring Russia to any degree. And this is something that President Biden was specifically asked about.
Sir, sanctions clearly have not been enough to deter Vladimir Putin to this point. What is going to stop him? How and when does this end? And do you see him trying to go beyond Ukraine? And a second question I'll just give to you now. This statement that he gave last night, the threat that he gave, the West will face consequences greater than any you have faced in history. Is he threatening a nuclear strike?
I have no idea what he's threatening. I know what he has done, number one. And number two, no one expected the sanctions to prevent anything from happening. It has to show, this is going to take time, and we have to show resolve. So he knows what's coming. And so the people of Russia know what he's brought on them. That's what this is all about. This is going to take time. It's not going to occur. He's going to say, oh my God, these sanctions are coming. I'm going to stand down. He's going to test the resolve of the West to see if we stay together. And we will. We will, and it will impose significant costs on him.
Now, a lot of people found this answer unsatisfactory. They want the US to do more, and specifically harsher sanctions. One of the sanctions that the US could do is kicking Russia off of SWIFT, which is a global financial payment system.
Mr. President, you didn't mention SWIFT in your sanctions that you announced. Is there a reason why the U.S. Isn't doing that? Is there a disagreement among allies regarding SWIFT and whether Russia should be allowed to be a part of it?
The sanctions that we proposed on all their banks have of equal consequence, maybe more consequence than SWIFT, number one. Number two, it is always an option, but right now that's not the position that the rest of Europe wishes to take.
So he says kicking them off of SWIFT is always an option, but as of right now, he says specifically it's not an option that the rest of Europe is wanting to take. I thought that was an interesting thing to say. He's saying that Europe doesn't want to take the option of kicking Russia off of SWIFT. Well, why not? Well, understanding what SWIFT is and the ramifications it would have, I think brings more insight to this. SWIFT is the Society for Worldwide Interbank Financial Telecommunication. It is a financial messaging infrastructure that links the world's banks. And currently, Iran and North Korea are cut off from it. So we are willing to kick different countries off of SWIFT, like Iran and North Korea, but why aren't we willing to kick off Russia? The unfortunate truth is that a lot of Europe depends heavily on the commodities that Russia produces. Critics say there could be economic blowback, not just in Europe, which has deep trade ties and relies heavily on Russia's natural gas exports, but also the rest of the world. Some former US officials say the move could severely hurt Russia's economy, but also harm Western business interests such as the major oil companies. So this seems like a situation where it would in fact damage Russia a lot to kick them off of SWIFT, but it would damage everyone else. Most of Europe relies heavily on their commodity exports, and the US would get hurt with their oil companies. So by this description, kicking Russia off of SWIFT would be a little bit of mutual destruction. Now, to compound these concerns, there's an additional part of booting Russia off of SWIFT that people are potentially worried about. Using SWIFT as a weapon could erode the dollar-denominated global financial system, including by fostering alternatives to SWIFT being developed by Russia and the world's second largest economy, China. That could undermine Western power, especially the diplomatic leverage that sanctions offer. So in a way, if we booted Russia off of SWIFT, that may actually encourage Russia and China to develop an alternative banking system and not be so dependent on the Western financial system, which in essence could undermine Western power. Now, it's unknown if that would happen, but it is a potential concern. So truth be told, this is a complicated and nuanced situation. Kicking Russia off of SWIFT would have both consequences for Russia and Europe and potentially the rest of the world. It's simply more difficult to sanction a country that you're somewhat dependent on. The US cut Russia's two largest banks from direct access to the US dollar, curtailing their activities. They say these sanctions are the toughest measures yet against the country's financial system, but leave room for the business to maneuver, especially in the critical energy sector. We can't really go after the energy sector because, again, Europe is somewhat dependent on that. They say these sanctions will have some effect, but they will fall short of a total shutdown. In effect, the actions will be more like sands in the gears of the Russian financial machine. So far, our sanctions of Russia will slow them down, but it's not going to stop their financial system. So that's where this stands right now. The sanctions aren't going to deter them. Russia troops are still on the move. There is some news that the Kremlin may be willing to talk, but they're sending mixed signals. And in my opinion, I think it's unlikely. Things have already escalated so much. Now, while this news going on is tragic and unfortunate, and it's crazy to be investing during a time that all of this is going on, I continue to believe that the events going on right now will not have a material impact on the prosperity of the companies that I'm invested in. I don't think it will have much of an impact on the overall prosperity of the United States as well. Companies like Apple and Microsoft, or even Amazon, Google, and Facebook have very little business in Russia or Ukraine. Neither of them are large economies, and none of the companies in my portfolio have any significant exposure to either of those countries. In fact, whenever I make an investment or do analysis on any company, I never factor Russia in terms of their total addressable market. I've completely ruled that country out as a potential market. I don't even consider it in the investment. So when I look at this news, as bad and unfortunate as it is, it doesn't realistically affect the investment thesis of any investments that I'm making. So I haven't sold out of the market or made any dramatic changes as a response of this news. Now I have, however, made one small change to my portfolio, which was Simon Property. I sold Simon Property for around an $800 gain and put that money into Microsoft. The reason is simple. When I look over my portfolio, I've been gravitating more and more to what I consider to be very strong, high quality businesses. And obviously when I'm comparing Simon Property, a mall REIT, to Microsoft, I think one of the most powerful companies in the world, Microsoft is obviously significantly a higher quality company. And the combination of the overall recovery in Simon Property, in combination with the recent dip in Microsoft, has allowed for an opportune time to buy this company. So I again recently increased my stake in Microsoft by another $5,000. My current stake in this company is $45,000, which is very significant because the majority of this is my money that I've deposited. It's not the gains in the company. With Apple, about half of the holding value is gains. Microsoft is the company I'm buying right now because I think when it was trading in the 270s and 280s, personally I think in the future that will prove to be a very good price for the company, so I've been buying more of it at those prices. Now another thing that's happened in my real estate holdings is Vici recently had their earnings report. Overall, the report was just fine. There was nothing great about it. There was nothing bad about it. It was almost perfectly in line with expectations. Vici missed their earnings per share by a whole 2 pennies, which is a 3% miss. So that's almost perfectly in line with expectations. They also beat their revenue expectations by $3.21 million. So this is almost perfectly in line with expectations. So in my view, this earnings report doesn't really change anything with the company good or bad. If you are bearish on Vici, you're probably still bearish on the company. If you're bullish on Vici, you should probably still be bullish on the company. Overall, nothing substantial has changed. Now, some people are actually upset that Vici is in the red a little bit since buying it not even 1 year ago. I'm down a few percentage points, which leads to $2,000 in the red, but I've not even held this company for an entire year. Not every company you buy is going to rocket to the moon right after buying it. Most of that stuff happened in 2020 when the market had an enormous sell-off and the Fed was stimulating the economy. That type of environment is gone. It's not going to happen as frequent anymore. Companies are actually going to have gains based off of their performance. And for Vici, I think this might take a little bit longer. I see a lot of future catalysts for Vici to move up in price in the future. The first one is their deals closing. Vici made a lot of deals in 2021. These are huge deals like buying MGM and the Venetian, and these take time to close. A lot of these are going to be closing over the next year. When these deals ultimately close, it will reduce uncertainty and it will make their cash flows and their AFFO more visible. So when that happens, that will be a future positive catalyst. Another thing is them getting to investment grade balance sheet. They've structured their debt, they've reduced bad debt, and overall they've reduced their leverage and diversified their revenue base. So that may put them into the category of having an investment grade balance sheet. If that happens, it lowers their cost of capital, makes it easier to get loans and debt at cheaper prices, and it will be another future catalyst that allows other investors to jump in on this investment. Another thing is the inclusion into the S&P 500. This is a little bit more of an unknown. It could happen in the future, but if they are included into the S&P 500, that is undoubtedly a good thing for the company. Another one is big institutions buying properties. Ed Petoniak, the CEO of Vici, has said that this type of investing in these larger gaming facilities and experiential property is going to be something that institutions and the old guards realize the value of in the future. And you'll see more and more of them jumping into these type of investments. We're already starting to see evidence of that. Wynn Resorts sells their Encore Boston Harbor assets to Realty Income Corp for $1.7 billion. It seems as though Realty Income Corp has diverted from their current business model to follow in the footsteps of Vici. They're now doing the similar type of investing that Vici's doing. They're not doing this because it's worse than what they were doing before. The reason that they're diverting into what Vici's doing is they see this as a superior business model. So Vici has been correct in their predictions that more big established institutions will follow in their footsteps later. But they already have a massive head start and own the huge majority of these type of properties. Another positive catalyst, of course, is not having so much dilution down the road. They've already made their big investments and their big buys, and they're not going to be doing that so aggressively in the future. I talked to Ed Petoniak, the CEO of Vici, personally, and he said, we're not going to have another year like 2021. We did an enormous amount of buys. There's a lot of dilution. We're not going to be doing it that aggressive in the future. So we're not going to have the same levels of dilution in the future that we had last year. And the last one that I would outline here is another possible catalyst is inflation concerns going away. Inflation is not great for the triple net lease space in general. Inflation hurts these business models because they are contractually obligated to have a certain amount of rent collected. They can't do what Starbucks is doing, raising prices on all their coffee, or what Amazon's doing, raising prices for Amazon Prime, or what Netflix is doing, raising prices on their monthly subscription. Vici has contracts with their customers, and those contracts can't be changed after the fact. So Vici is a company that will become more attractive to investors as inflation abates. So I realize that Vici has not been a rocket ship to the moon the minute that I purchased it, but it's also not been so bad. The company is down slightly since its original purchase at a time that many companies are dropping 30, 40, or 50%. This one hasn't been performing bad. It's been collecting 100% of rents. All the deals that they have in the works right now seem to be going well, and I see a lot of future catalysts for this company. And if it takes a little while for the company to go up in price, I think I'm okay waiting. Every single quarter, every 3 months, I get $400 in cash deposited to my brokerage account from Vici. So this is a company that also pays me to do nothing. So as of right now, what I'm doing with my portfolio is looking for opportune moments to buy companies that are high quality and selling at an unreasonable discount. I continue to have over $6,000 in cash. The reason I leave this here is if there's just some company in my portfolio that I really like that drops down amidst all this volatility. I don't want to just throw this money into any company. I really want to wait for an opportune moment. With the Dip Finder, I can see different opportunities that are arising in my portfolio. This is a tool that's available to all Patreon members. It shows you the performance of every holding on the current day. So every single holding in my portfolio is in the green today. But overall, there's still a couple companies that are in a significant dip. T. Rowe Price is in a dip. I purchased $1,000 of that one. BST is also in a dip. That makes sense because this is a software covered call ETF. So a lot of the holdings they have are just getting sold off right now. Then of course, Target has sold down significantly. That's one that I'm looking at. Every time I compare Target to Costco, I just end up preferring Costco's subscription business model. But if Target does get cheap enough, if this dip continues, goes down 25% and 30%, I'll probably be picking up more Target. The other one is, of course, Starbucks. This is a company that I bought $25,000 of at around $96 a share. It's traded down slightly more to $92 a share. If Starbucks goes into the mid 80s, if it goes down around 85, I'll be deploying the rest of my $6,000 into this company. Now, Nike has continued to dip. It's down slightly, but as I've outlined before, at a 30 PE ratio, I'll be picking Apple and Microsoft over Nike. If this one gets into the range of the mid or low 20s PE, I might look at buying more of this company. A couple other companies that have joined in on the dip are Home Depot and Jpmorgan. These are two companies that had significant sell-offs over just the past couple of days. Home Depot stock is down from $411 to $315, so it's down around 24% from its recent high. Now, while a lot of investors looked at the dividend increase of Home Depot as a positive thing because it was a 15% increase, this is actually a slower rate than their 5-year average. So their dividend increases are decelerating over time, they're not accelerating. This is what their dividend increases look like over time. It's pretty consistent overall, and every year I expect them to grow it at least above 10%. So Home Depot right now is another option I have, but it still hasn't gotten into that territory of being a screaming buy. Jpmorgan is another company that recently had a decent sell-off. I've outlined Jpmorgan as a very high quality, albeit somewhat expensive bank. It trades at a 1.7 price to book ratio, and it's almost completely flat for the past year minus dividends. I'm actually confused of why investors are selling out of this bank. I think the biggest reason why would be if you think there's a chance we could go into recession. That's the only reason you would not want to own financials. Like you can see throughout history, of course they don't do well during recessions. But if we go through a time of higher interest rates without inflation, the banks actually stand to benefit. So Jpmorgan actually stands to become more profitable as interest rates rise. So as of right now, the companies that I've really done recent buys in are, of course, Starbucks. I bought $25,000 of that company. I bought an additional $1,000 of T. Rowe Price. And then just recently, I sold out a Simon property to buy $5,000 more of Microsoft. Now you might say, why am I buying Microsoft when it's not on a significant dip? But for a company like Microsoft, even getting this company close to its 200-day moving average has been a very good strategy so far over the past 10 years. Companies like Microsoft, Apple, and Costco very rarely go down 20, 30, or 40% below their 200-day moving average. In fact, that rarely ever happens with companies of that quality. So when I see a company like Microsoft trading down even a little bit below its 200-day moving average, historically that's been a very good time to buy this company. And of course, with the fundamentals of this company and the future growth outlook, and with their recent deal of Activision Blizzard, I see significant upside for this company, and in my opinion, a low chance of permanently losing money with this investment. So that obviously comes with a disclaimer, anything can happen, the future's unknown, but personally I feel fine committing a lot of my capital to this one company. So that's the update for today. I hope you enjoyed it, and I'll see you in the next one.